What's a derivative? Futures, options, swaps. Well, those would all be reasonable answers, but they don't speak to the substance of the issue. Those are names, not descriptors. Well, how about the common definition? A derivative is something that derives its value from something else. That definition is so vacuous as to be completely uninformative. Indeed, if one were to take the words too literally, it's downright misleading. Hi, I'm Doug Carroll for InsidersGuideToFinance.com, here today with a brief video presentation to try to clear up some of the uncertainties and mysteries surrounding derivatives. I don't know about you, but I think I was probably in the financial business 5, maybe 7 years before I had a clear understanding of what was the true nature of derivative contracts. Oh, long before that I realized the distinction, at least by the categories, between securities and derivatives, stocks and bonds being securities, futures, options, and swaps being derivatives. But I didn't have a clear understanding of the true nature of derivative contracts. Let me share with you what I think is some insight into the real characteristic, the substantive aspects of derivatives that make them distinct from securities. Let me start by more formally stating the definition of derivatives I'd mentioned earlier. A derivative contract is a financial instrument whose value is derived from the price of some related security or commodity or instrument. Now that's not a different definition, that's just a more formal statement of the very simplistic definition I started out with earlier. But it is really no more enlightening, because think of the literal implications of those words in terms of the price action in a derivative market versus the price action in a related securities or commodities market. And to be able to state things a little bit more specifically, let's talk about a specific instrument, like the S&P 500 actual index versus the S&P futures. If the common definition was literally true, what would be an accurate description of the action of the traders in the S&P futures market? Well, if the common definition was literally true, anytime new information came out that might affect equity prices, well, the traders in S&P futures would have to sit on their hands and wait for the traders in the actual stocks to move and react first. And only after the actual S&P index had moved could the futures market drag along in its trail. Now, I'm not saying that's what literally happens. I'm saying that's the literal implications of the words of the common definition. And yet, what are the statistics? Well, it turns out in the vast majority of instances, on the release of new information that might affect equity prices, the futures move ahead of the actual stocks. Now, some people hear that and they might think it's more like the tail wagging the dog than anything else. But that is actually not uncommon. There are many sectors where futures markets might move in advance of the related securities or commodities market. Why might that be? Well, one explanation is that all markets are in the business of price discovery. What's price discovery? Well, let me talk around the issue a little bit. Presumably, participants in any market would rather make money than lose money. Now, I can state that more formally. Market participants want to maximize their risk-adjusted return on capital within some risk constraints. But that's just a fancy way of saying they'd rather make money than lose money. Well, what's going to make that the likely outcome of anybody's activity in the market? Well, it would be a result of good buy and sell decisions, and that's presumably meaning their actions are based on the fruits of their research. Now, it might be fundamental analysis, where market participants are looking at company annual reports, government economic releases, industry reports on sales and earnings trends. Or it might be technical analysis, where the market participants are looking at financial market generated statistics like new highs versus new lows, advances versus declines, support and resistance areas, and the like. Or it might even be based on quantitative analysis, and without getting into it in too much detail, that would be where the analyst or investor is looking at, in many cases, the same sort of statistics fundamental analysts would be looking at, but using it much more like the technicians, that is, they're looking for patterns in the data. But Without getting into it in any further detail, the point is that all market participants are engaging in one or maybe even several of those sorts of different types of analyses, and then basing their investment decisions on that, to buy or sell, to increase or lighten some position, to hedge or unhedge a trading position. And as markets respond to those buying and selling activities, the fruits of their research get reflected in price discovery. So all markets engage in price discovery, whether it's a derivative market or a securities market or a commodity market. So why might a derivative market move first? It's a function of concentration of resources, people, capital, and technology. And in those market segments where you have a greater concentration of resources, chances are that market segment will move first most of the time. And it's not just S&P futures versus the S&P actual index. Another market where the futures oftentimes move ahead would be Treasuries and Treasury futures. How many different Treasury securities are there? Well, if you look at just the issues of bills, bonds, and notes, north of 300. How many futures contracts are there? Only 7. And in many days, there is a greater volume of trading of Treasury futures by notional value than par value of Treasury securities actually traded. That smaller number of contracts allows for a greater concentration of resources, and that would explain why Treasury futures often move ahead of the actual Treasury index. Now, the common definition is true in an arbitrage pricing sense. Consider the standard formula that's often used to convey the concept of forward pricing. The futures or forward price is said to be equal to the spot or underlying price. Now, the standard formula I show there shows 1 plus R, that's 1 plus the interest rate. More generally, in place of R, it ought to be cost of carry, all the cost of holding a position in the underlying, raised to the tth power, where T represents the time until the delivery of the futures or forward contract. Note, however, with a simple algebraic manipulation of that formula, dividing both sides of the equation by 1 plus R to the T, now you'll note that factor is in both the numerator and denominator on the far right-hand side of the equation. Well, of course, that would cancel out. And the revised formula at the bottom of the page, well, now it makes it look like I can derive a spot or underlying price from the futures or forward price. Note, both of those formulas are true. Given the price of one and knowing the cost of carry, I can calculate the price of the other. So yes, given the spot or underlying price and the associated carrying costs, I can calculate the fair value of the futures or forward contract. On the other hand, given the futures or forward price and the cost of carry, I can calculate the fair value of the spot or underlying price. Consider again that formula. Now, all too often, people not knowing better will make the mistake of misinterpreting the general characteristic of the two prices, stealing the language of statistics. Oftentimes, those not knowing better will think of the spot or underlying price as the independent variable, and the futures or forward price as the dependent variable. Ergo, they get the causal direction of the relationship in error sometimes. The reality is that since both the spot and futures or forward price are responding to the same factors, that is, market participants in both markets are trying to get value to the right level as quick as possible, in effect, they are interdependent variables. So what that formula really tells you is not how to derive the derivative price from the underlying price. What that formula specifies is what's the relative fair value of the derivative to the underlying instrument or asset. So if derivatives had a name that was a descriptor, they'd be called relatives, because that's what that formula tells you, what's the right relative value. But of course, they're known as derivatives, but understand derivative doesn't really mean something that derives its value from something else. I hope you enjoyed this video. You can go to our YouTube channel or Facebook page to see other videos on a range of investment-related topics. Or you can go to the website, insidersguidetofinance.com. At our website, in addition to the free video shorts, There are a series of modestly priced, in-depth training videos with running times of approximately 1 hour each that go into a number of subjects in greater detail. The website and Facebook page also contain information about open enrollment programs I will be presenting over the next few months, and my recently released book, The Insider's Guide to Fixed Income Securities and Markets.